Hello, everybody, and welcome back. Today, my guest is Mike Kerley. Mike is a portfolio manager for Asia Pacific Equities at Janus Henderson Investors. And today, we want to discuss recent development in Chinese financial markets. Welcome, Mike.
Thank you.
Mike, China is cutting interest rates in contrast to the rest of the world. So what does that tell us about the state of Chinese economy?
I think the pace and the speed of the decline in interest rates has probably surprised a lot of people, as has the decline in the economic growth profile. So despite Xi Jinping talking about 5.5% GDP growth in China, clearly that's a target that's now not going to be met. And we've seen some tentative measures towards China revive the domestic economy, partly through interest rate decline and various other measures. But as yet, we haven't really seen that take hold. So I think what this tells you, the more interest rates that get cut, the weaker the economy is.
Hi there. Just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. China's COVID policies are weighing on the economy. So how will these measures affect economic growth and profits in 2022?
Well, I think this is the main cause of the economic weakness. And the main reason why we haven't seen more significant economic measures to revive the economy, because it's a bit like pushing on a string. If you come up with economic measures, yet a large percentage of the economy is locked down because of COVID restrictions, then it kind of doesn't make a lot of sense. So the COVID policy, the zero COVID policy, we think continues at least until the October party conference. And even then, after that, it's going to be a little bit difficult taking a different tact, if you like, towards COVID, especially when large percentages of the population remain not as vaccinated as probably you would like.
The delisting of many Chinese companies in the US seems to be off table for the time being. But to what extent will these events nevertheless change the significance and the meaning of the Chinese capital market?
Well, I think, it was a coup, or has been over the last 20 years, the number of large companies that China has managed to list in the US markets. And these have been quite significant parts. Certainly, they were quite significant parts of the big run-up in the internet-related stocks through 2020 and 2021. The fact that we now have the potential that they will be delisted because of audit irregularities from the US side, I don't think really helps anybody. But this is all about politics. Politics very rarely helps anybody, as we well know. So ideally, you would like these companies to remain listed and remain open to the US investment base. But if they move elsewhere, that's going to be less likely. China wants greater involvement in its financial markets, both from domestically and overseas. And this toing and froing regarding the ADR delisting, it really, as I say, doesn't really help either party.
The real estate bubble is not only a burden on real estate developers in China, but also on banks or the whole financial service sector there. How long will be the deleveraging and the aftermath drag on Chinese economy?
I mean, it obviously is down to policy. And as we talked about earlier, in terms of what policies are needed to revive the economy, one regarding property and getting the consumers back to a more positive view on purchasing property is part of that revival. I mean, clearly the measures that Xi Jinping has brought in, i.e. properties for living in, not investing, and the deleveraging of the property market was one of the key priorities. But clearly, when that coincided with COVID, we ended up with liquidity problems in the property market, which were unforeseen. So again, it kind of sits in line with the revival of the Chinese economy. Post the party conference in October, I expect to see more measures in terms of getting uncompleted properties finished, increase liquidity to the developers, and also probably some incentives for people to purchase property.
China's incomes have risen enormously during the past decades. So which industries and companies are benefiting particularly from the growing middle class in China?
Well, I mean, disposable incomes are rising across the board in China. But you're absolutely right. The middle income families are generally benefiting the most. So it's discretionary areas, consumer discretionaries, and probably mid to high end probably luxury goods at the moment. They've certainly been the most resilient during the pandemic phase. And we've seen that benefit not only Chinese companies, but companies in luxury brands in Europe and the US, etc. So I think consumption is the key. It's increased disposable income and people trading up in their aspirational purchases.
The Chinese government focus is now increasingly on private companies. So which industries benefit from this new attention and the rediscovery of the private sector?
I think going forward, the Chinese want a balance between how the state sector and the private sector. Clearly, the state sector is important for making sure that government policy is pushed through into local communities, et cetera, et cetera. The private sector is less controllable, clearly, but employs a lot of people, especially in the service sectors and the consumer side and the manufacturing, et cetera. So I think we will see the continual promotion of both state and private companies. I mean, that took a slight setback recently with the regulatory clampdown on some of the internet names, which are clearly private companies. But going forward, I think the Chinese realize that in order for the development, especially of employment, youth employment, that you need some of these innovative private enterprises to continue to employ graduates as they come out of university.
Semiconductors and other high technologies. So China is trying to become independent of the West in many areas. So there's this expression of dual circulation also around. So where do the investment opportunities lie in this trend?
Well, I think self-sufficiency is key for China across the board. I mean, you mentioned semiconductors, which is really very, very important, but you could extend that out to basic materials, resources, et cetera, et cetera. But on the semiconductor side, it's difficult in some ways. And actually, the best opportunities probably lie outside of China, maybe in Taiwan, et cetera, because we'll see constant and ongoing clampdown from the US to try and contain the development of the Chinese semiconductor space. There are companies you can invest in. But again, you have to bear in mind these geopolitical issues and the clampdowns on either the supply of raw materials or the sale of the ongoing goods. So semiconductors and self-sufficiency is key for China. It's really difficult at the moment to actually establish how they're going to achieve that in this current environment.
So last year was not the very best year for Chinese stocks. So how do valuations of Chinese companies compare internationally, but also in Asia now? And what are the current arguments in favor of Chinese equities?
I think the valuations are compelling. And I think that's reflective of the fact that we've had quite a lot of uncertainty. I think China's basically underperformed because it's gone through the tightening phase, if you like, before everybody else. But then again, that's probably the opportunity. The rest of the world did very well when we had ultra low interest rates and excess liquidity, drove up equity prices and asset prices in general, whereas China was doing the reverse. It was worried about overheating. Now we've got the complete reverse of that, where the rest of the world is worried about overheating and inflation, whereas China is actually loosening. So I think if you just look at that in very simple terms, I think you could argue for a reversal of the equity outperformance of the US versus China going forward, for example. I think that's probably one of the biggest strong points. The second is I think that the Chinese will get this right. I mean, I think there's some people who've said that they kind of dug themselves into a hole that they'll struggle to get out of. I think it's more about a question of timing rather than necessarily the fact that they have no answers. So I suspect 2023 will be a much better year for China than we saw in 2022 or 2021 for them. And in terms of valuations, well, they're way below long-term averages. So for someone who can take a slightly longer viewpoint, maybe can close their eyes over for short-term volatility, which I fully expect to continue. But in the long term, this is probably a decent opportunity for Chinese equities.
So this was Mike Kerley from Janus Henderson Investors. Thank you very much, Mike, for being with us today and sharing your insights.
Thank you very much.